I think you're absolutely right. The kind of rally which we've seen coming into the summer already was one of the strongest rallies we've seen coming out of a bear market, obviously out of one of the biggest drawdowns. And I think what concerned us was definitely the kind of increase in valuations, which was boosted by policy support, in particular the decline in real yields, and that really clouds the long-run return outlook. And the kind of idea of fat and flat is really about the kind of longer-term 12-month plus outlook, where these high valuations will become a bit of a speed limit, but also increase the vulnerability for the market. I think what happened now in August, to some extent, is adding to those longer-term concerns, because this is to some extent what always happens after a bear market. You get like an initial very sharp recovery, and then you get like a period where the market actually sees what type of earnings growth you're really getting, and depending on the type of earnings growth you're getting, returns will potentially be higher or lower. And we kind of feel that after this initial explosive recovery in growth, there might be a bit of disappointment on what you actually will get on fundamentals. But having said that, this rally in August has been very well underpinned by tactical fundamentals. I think you saw a continued decline in real yields, and on top of that, the macro data has been incredibly strong. So you see macro surprises, you see like the lead indicators really shifting to very high levels, and all of that tactically can support the market moving a bit higher. There is, however, some warning signals we are currently seeing in the positioning. So I wouldn't be surprised if it will get a bit more bumpy, and that's certainly what the VIX is telling us. I think you currently see actually the market going higher together with the VIX, and this has historically not been a good signal. The same was, by the way, true before the drawdown we had in February, March.
So the question then is, how does this underperformance going forward express itself? I mean, there are, just like you, others like John Hussman, I was reading their latest note where they now think implied returns on a traditional 60-40 portfolio are negative over the next decade. That is terrifying for those who are trying to steward their money at this stage. So in terms of how this happens, do we get a sharp pullback imminently, or do we see the balloon slowly deflate and we get subpar returns over a longer period of time?
Yeah, it's a good question. I think my sense is the type of policy support right now, which you have, is to some extent reducing the risk of a really sharp kind of correction, because you have a lot of buffers in place. So nevertheless, you can have corrections even if you don't have bear markets. And just to give you a sense, the put-call ratio in the US right now is at one of the lowest levels on record. There's an enormous demand for call options on these kind of popular tech names. So these type of names, they are currently have a lot of short gamma, essentially like both on the way up and down moves are exacerbated. So from that perspective, a relatively small shock can actually drive a pretty outsized response in share prices. So I think you can have a sharp correction, I would argue, but the depth in terms of how deep it can fall is a bit limited by the policy support as of now. I think from that perspective, I would argue you can have a bit more bumpiness, a bit more fat range, but I would be surprised if we really go kind of back into a bear market type situation considering all the policy support.